Okay, let's get started. So, why do we incur risk? As a layman person, why would you want to take risk in anything? Think about it.
so that we can get like more income and everything.
To achieve something, right?
Yeah.
Whatever our goals, we are willing to take the risk for that. If we want to buy something, the risk is getting outside of the house. So that we achieve that goal of going to another place, right? So businesses similarly must be able to identify the risk that they are willing to take, and they are able to assess that risk, measure that risk that the organization might face. So when you are making an investment, there is a various type of risk, the types of risk that we will go through, that the organization faces. So risk facing an organization are those effects that achievement of its overall objectives, so which should be reflected in the strategic aims, and risk should be managed properly, and there should be strategies aligned with it in order to comply with this risk to mitigate that risk. Okay, so why do we incur risk? To gain the competitive advantage and increase our financial return. Okay, so this is the risk management cycle. First of all, we will first of all identify the management group and set the goals for the organization. Okay, and then we identify the risk behind these goals. As we gain the understanding about it, we will understand them, we will assess the risk of it, then finally we will develop a strategy. How do we respond of that strategy? Maybe there is a threat arising, there is a political risk is there. So what should be our response in that? Finally implement it, allocate the responsibility to employees, implementation and monitoring of the controls that we have put into the organization, and final review. All this revolves around the information for decision making, the data we are going to collect, and that will help us in decision making. Okay, this is your cycle, risk management cycle. Now this is important, what are the types of risk we will have? Okay, these are your international risk. If you are moving to sell your products outside your country, fraud and employee malfeasance risk, when your internal employee has the opportunity to do some fraud, maybe manipulation of records, something like that, maybe stealing of records, stealing of products. Corporation reputation risk. Reputation is the important for corporate, because if you are maybe using child labor and your country bans use of the child labor, so there is a reputation risk, there is a legal risk as well. So like for instance, in the country you have outsourced the manufacturing plant, and in that country the child labor is acceptable. But what if your society in your home country gets to know about that you are exploiting child labor, that even though you are legally right, but still your reputation in the eyes of the society, that would be bad, and they could also boycott your products. Environmental risk, if that your product is going to harm the environment, maybe through a chemical spill, through some gases, through maybe you are cutting down the trees, you are using non-renewable resources, that will come under your environmental risk. Technology risk is risk of technology again keep on changing. So how do we going to keep up with that? You will have to train your employees. Financial risk, not having the ability to finance your investments. Economic risk is related to your customers. We will go through that. Business risk has its own different categories. And your political, legal, and regulatory risk. Legal risk, like if you're not able to comply with the laws and regulations. Political risk is the risk related to your change of government. Okay, let's read through that. First, we have business risk. Under business risk, the nature of operation and the product. Some businesses, for instance, reliant on the single product or some range of products. So, business risk is the operation that you're going on having the risk in that only. So strategic risk is the any strategy that you are making, like acquisition or product launches. If that fails, that is one kind of a risk. Product risk, if you're not launching a new product and if that goes to the failure, what are you going to depend upon? Commodity price risk is the risk that depends upon the raw materials that you're purchasing, like oil prices fluctuates very quickly. So if you are relying on the oil, that is going to have a greater risk. Product reputation risk, same I told you, the risk of change in the product's reputation in the image of in the front of your society, customers. Operational risk, the risk that the business operation may be inefficient or business process may fail. Okay. Then you have contractual inadequacy. That means that if you have made some contract with some supplier or with a client, and you have if you are not able to withhold to that and you breach that contract, so what is the risk behind that? You will have to pay penalties, you might have to go to jail, something like that. That will comes under your contractual inadequacy. Fraud and employee malfeasance, I told you, if your employees do something wrong, any offense, any fraud, so maybe they are stealing something from you, if they are providing data to some third party, your competitor, that is your fraud and employee malfeasance. Okay, these are the examples. You can go through these. Okay, is there any doubt?
No.
Okay. Now, risk management. How we are going to manage the risk. We have learned that these are the risk and the type of risk. Now, the management is important because the understanding and assessing the scale of the risk, that if it is a higher risk, we should be able to manage that. Otherwise, it could impact our company in a very bad way, with which we might have to also, worst case scenario, we will have to shut down the business, right? So these are the risks which are inevitably subject to attempt to achieve the corporate objectives. For this, we have this where do we have this strategy, Tara? But have you gone through Tara strategy?
Tara,
No.
no.
Okay, we will go through that. Okay, so there is two type of risk: downside and upside risk. Downside risk is when there is only one of the traditional view is the one of the protecting of the organization from loss. So there is only one way that your risk is only at the lower side. Like it can only go bad. But upside risk is there is a chance of getting better things also. There is a chance to get increase in the returns. That is your upside. Okay. This is conformance and performance. Like in conformance, how you can manage controlling the threats or hazards that says bad things do happen, and managing your performance, maximizing return or opportunity, saying that the good things might not happen. So you will have to make it happen. Okay, so this is risk management, 4 stages given by EY. Establish what shareholders value about the company. Go through their profile and understand what, according to them, what is value creation, and then identify the risk around every key shareholder, and then determine the preferred treatment for these risks. Similarly, like normally understanding the shareholder, understanding the risk, understanding the treatment solutions, and finally communicate these threats to the shareholders. This EY one is not that much important for point of your exam, but this is more like for the knowledge. Okay. Then we have this business strategy. So, what the company will do in relation to your risk. First of all, you should understand the risk appetite. Risk appetite is how much risk that business will be able to will accept. Appetite. Remember, we had different type of attitudes. So under this, we have attitudes like your risk neutral, risk seeker, and risk averse.
Yes.
Yes, that is your risk attitude. What is the approach to look at the risk? And then you will have to understand the risk capacity, maximum risk they are willing to take. Maybe, someone asks you to make a bet against $1, right? You're able to accept that. But if someone asks you to bet against $100, then you will hesitate. Okay, there is a chance that I might could lose $100. So what is the maximum risk you are willing to take? Okay. Maybe you can go up till only $10. Okay, I can't lose more than $10. So I will only bet against $10. So this is your maximum capacity, maximum risk that you are willing to take. Okay. So under risk appetite head, we have your risk attitude and risk capacity. Then we understand now what is the risk appetite. Then we will move towards the risk strategy. Now, how we will be able to manage this risk. And then finally, there is going to be some residual risk which cannot be managed. Okay. So, for example, you are doing an event that is in the open area. Okay, and there are chances that there might could be rain. Correct. So you can manage that by putting the tent. Okay, that could protect you from the rain. But there again is going to be the residual risk that the rain could be, the water droplets could be coming in between the tent. So that is the residual risk that cannot be managed. Okay, so that is your theory. This is important, like in perspective of like the basic foundational level. And yeah, this is important, like very important. Tara framework. It's a management method or technique that uses Tara as its short form. Okay, this is our risk mapping. So, when we are analyzing any type of risk that we have, so there is the impact of that risk on the company, and there is a probability of arising of that risk. If there is a low probability of that risk might could happen, and there is a low impact of happening of that, so what should we do? We should accept that risk. So for instance, it differs from scenario to scenario, like the example of I gave you about the rain. Okay, so there is a probability of arising the rain is low, and the impact of its happening affecting our company is again low. So what should we do? We should accept that. Okay, then if the probability of arising that something is high and impact of that is low, then what should we do? We should reduce the risk. We should reduce that by some like maybe putting some uh, technology into place, maybe putting sprinklers like that, or maybe using some people who could reduce that fact. Okay, I will go through the example which will help you more. uh, is there any example? No, there's not. Maybe in the question we will see that. Okay, then we have this one. When the probability of uh, arising is low and impact is high. Okay, for example, there are some customers who doesn't pay back to us. So the probability of arising is that low. But if that customer doesn't pay us, we are going to have a loss. So the impact is high. So what should we do? We should transfer that to the third party. Maybe take a insurance for those kind of customers, make a provision. So that is a transferring of the risk to the third party. Okay. And then lastly, if the impact is high and probability is also high, we should altogether avoid that risk. If both of them is high. Let's see one example. Potential loss from adverse outcome is a function of the probability or the likelihood of the adverse outcome will occur and the impact of that if it does occur. The initial review is carried out to identify and assess the risk. The assessment of both probabilities and impact might be based upon the judgment and experience rather than on the detailed statistical and numerical analysis. This is more subjective based upon the judgment. Initial analysis might be sufficient to categorize your high or is it low, is it medium, is it high, both of them. Similarly, you can also make it as severe or not severe. So, where we make a risk map of something like this. So, here they have given some example. Probability is high and impact is low. So, what should we do? Remember TARA.
I
Transfer, accept, reduce,
reduce.
and avoid. Okay, so which one is this? Impact is low and probability is high. We should
Probably
reduce that.
reduce. Okay.
Hmm. So new audit regulations for the profession is coming. So you can reduce that by learning what is the new regulation that is coming.
Mm-hmm.
Okay, so they would have given this uh, low impact, high probability, and this. Okay, they have not given the solution. Okay, then probability is low and impact is also low. What should we do under these four?
Accept.
Yes, except if there is an increase in salaries above the general rate of inflation, what can we do about this? We can only accept and pay the
Mm.
higher salaries.
Yes.
Then probability is high and impact is also high.
Avoid.
Yes, if there is a loss of audit work from the existing clients, we can't do anything about this if there is something bad that has happened already. We are only going to we only should avoid this kind of a risk, right? By
Yeah.
making more relationships, better relationship with the clients. Then finally, probability is low and impact is high. Then
Transfer.
transfer. So the loss of audit clients within the next 2 years. If that is going to happen, we should transfer this to the insurance company, maybe to protect us, something like that. Okay. Let's see some examples, some questions of Tara. Okay, this one 221.
A business is faced with a risk that a high probability of occurring and a high negative impact. If it does occur, it is not strategically vital for the business to undertake the activity. High probability and high negative impact. So we avoid.
So we avoid. Yes, right.
Avoid.
So it's a B.
Yeah.
Right. Next.
A business faces a risk that has a low probability of occurring and low negative impact. So reduce.
No.
Wait, low negative impact. So low impact and low probability. Oh, so accept.
Yes.
Accept, yeah.
It won't be that straightforward. Both
Mhm.
is given to you. Like they might could be more tricky. Okay, this one 220.
Mm. A business is faced with a low probability of occurring and a high negative impact if it does occur. But the related activity cannot be avoided because it is strategic to entering the business. So it has low probability and high impact. Low probability, high impact. So transfer.
Yes. Good. I hope you are clear with now what is Tara and how to deal with that, right?
Yeah. When you said Tara, I couldn't remember it, but when it was said risk mapping, I think I sort of remember the
Oh,
part.
okay, great. Okay,
Okay.
CIMA Code of Ethics. Have you done this before?
Yeah.
Yeah, you're clear with this?
Yeah.
Can we do some question on this so that I know you are clear with it?
Okay.
Let me see if there's some questions. There is no question. Mm, When did you do this before? The CIMA Code of Ethics?
It was there in the first level.
Yeah.
It was E1 and all that.
Okay, okay, okay. Okay. So should I go through this or you are comfortable with that?
I'm okay with CIMA Code of Ethics.
Okay. Because this is important, even not just for your current level, even in strategic level also, it's really important. Okay.
Yeah.
Okay, threats and safeguards. So some threats can arise in your or work life, like conflict between requirements of the employer and fundamental principles. So your employer sometimes can ask you to do some unethical work. So there the conflict will arise. So what is the safeguard against that? Obtaining advice from your employer, like other senior manager or something, professional organization or professional or advisor. Employer providing formal dispute resolution process should be there in your company, or seek a legal advice. Preparation and reporting on account information. So accountants needs to prepare information fairly, objectively, and honestly. So they could be pressurized to do some misleading information, like manipulation of the statements. So consultation with your superiors is important. Consultation with those charged with the governance, and consultation with relevant professional body if someone is pressurizing you to do that.
Mm-hmm.
Having sufficient expertise. So if someone is giving you some work and you don't know how to do that, so you should be faithful for true with them and tell them that you don't have that level of expertise, or otherwise obtain additional advice that is required to do that work, get the training for that, or negotiate one more time about the duties. Maybe duties could change, or obtain assistance from someone who has that expertise. Financial interest, if you have a client which in which you have financial interest, maybe your client is one of the company in which your close family relative or member has some shares in that company. Okay, so that is a self interest threat. For that, remuneration being determined should not be based upon the performance that you're performing. You should do the disclosure about this relevant interest to the company. Consultation with superiors and relevant professional body should be there to establish whether is this actually a conflict of interest or not. So they will tell you whether you should go ahead with this client or leave it for now. Inducement, if someone is giving you offers for doing something, so do not accept that and inform the relevant third party, like your senior manager. Similarly, giving offers, if you are giving bribe to someone, so simply the safeguard is do not do so. All right. Confidential information, you should not give any information to the anyone else regarding the work that you are doing. So sometimes that could happen, like your employer is asking you to give some client's data, so there also you are not authorized to share the client's data. So do not disclose the information in disclose information in compliance manner. Only tell what is important, and do not tell like anything else. Whistleblowing. Whistleblowing is a situation where you are considering disclosing information about your company, something ethically that is not right in the company. Okay, you are doing this, but for that you should follow the disclosure requirements set out by the company. So every company has its own policies. Do that according to that, and maybe tell to the concerned people in the organization. Example, report to those responsible for governance. Otherwise, disclosure should be based upon the assessment of legal obligations should be there when whether members of the public will be adversely affected. You should know that what you are doing is going to affect people. So first of all, you should also know that what you are disclosing is also correct, and the likelihood of repetition should be low, and should be more. That is why you are doing that. Maybe something one time happened, like, this is all subjective, although reliability of the information and reasons why employer does not want to disclose. You should get your facts straight first of all. Okay, this public interest, there are, like, other stakeholders like your clients, credit providers, your investors, government, employer, employees, investors. You can go through that. Organizations as a shaper of society. Shaper of society is known as only when a company is doing something extra beyond their obligation. So there are companies who is, like McDonald's, who are making fast food, which is not a shaper of society. They are making society, giving bad habits, right? But there are again the companies who are, giving, providing something better for the people. Maybe who is, for example, it could be like Toyota research that solar powered cars is coming, so with which you are able to save energy, you are going to less pollute the environment, and then you are again making it much more easier for the people. So it can be seen as an obligation to society, providing pollution free transport rather than continuing manufacture petrol burning cars. So as I said, you're doing something extra for the society in the benefit of the society, not just to gain income from that. Cost benefit analysis, you would have heard many times, analyzing cost versus benefit. You are making a decisions against the cost that is going to be arised out of that, and the benefits you are getting for that. So in cost benefit analysis, your benefits should be larger than your cost. Otherwise, if your cost is high, then your benefit, obviously you are making, some bad decision, or there must be some other factors. For example, if you are taking a new job, there is a cost involved relation to your reallocation. First, if I take only the case of the reallocation, let's say that is your $10,000, and the benefit you are going to get is that you might could get the job for which you are relocating. The salary that you are getting is 5,000. So here you can see the benefit is lower than your cost. So here you should do the cost benefit analysis and understand whether the decision you are making is right or not. So here you can go through this example illustration. It's pretty simple. Okay. If you are getting a new system, investing in a new system, the cost involved, initial cost is the design, develop, developing of the system. If software is the uh, purchase price of the software, purchase cost of new hardware, training cost, cost of testing. But also running cost is also involved. That is, you should take into account like your labor time, materials required, replacement parts, cost of service support. Okay. And then clarification, classification is there: internal information and external information. That, internal is from your, that you are going to capture yourself, the processing cost, the salaries paid to the payroll. Indirect cost, like information collected which is not needed or duplicated. External information from your newspaper, from wasted indirect cost, wasted time finding information. Then management cost, then your infrastructure cost, like internet searches. Indirect cost of producing information is the most expensive cost of producing information, which could also lead to nothing that you are getting from that information. So people collect data, input data into the system, process the data, and then output the resulting information. Throughout the process there is going to be the wages involved, and labor becomes the part of the major cost, and new people is hired, process is changed, software is upgraded. So there are a lot of cost behind all of this. You can go through this, like other indirect cost, like, and your benefits of new information system. Efficiency will be increased, better quality of information, better access to information, improved sharing of information, improved communication, better decision and customer service. Okay, then we have risk in the computer systems. If you are having the computer system in your digital era, there is a hacker involved, industrial spy, viruses, malicious softwares could be introduced. Accidental mistakes could happen if you are inputting the wrong things into the system. Inadequate security, faults in the hardware system. There is also human error. Like, they sometimes press some button which could directly delete all the information, right? There are some or a lot of risk involved this in kind of softwares. Then other risk is also here: risk of hardware theft, physical damage, damage to data. There could be damage as per your natural calamities like flood, fire. Operational mistakes could be there. Fraud and industrial espionage could be there. False transactions, like anyone could enter the data. So data protection legislation is now have come, which is your, as per your data protection act, that you cannot give any data to anyone. You cannot sell the confidential data, the personal data you hold of your clients. That comes under your data protection act. Have you heard about GDPR?
Yeah.
What was
And
that?
uh, the data protection, the regulations and everything. Yeah.
Hmm. Which state out penalties that you will have to pay, which is like a lot that you will have to pay, and you have to suffer loss through the improper use of the data. So this is also important if you are collecting any kind of data. Okay, then your hacking is there. You can go through that, right? Viruses. Should I go through
Oh,
this?
no, no, it's okay. It's
Okay.
just to read, yeah.
Yeah, it's just to read. Then advantages and disadvantages of internet. Okay, this is important. Your big data. You have you done this in operation level?
Which one?
Big data.
Yeah.
Do you know what is a big data?
Big data, yes. It's like, um, how do I explain this? Um,
Big data, as the name suggests, it's a large volume of data. A
okay.
data that we even see in in this era, like there's a huge volume of data that each company is collecting now. Data can be in so many formats, like your likes is also a data, comment is also a data, pictures is a data, your videos, your mp3, or what could be the data, excel format, your PPT, your PDFs, and normal Word files. So much formats are there now. So a huge collection is going on. So big data systems include your social network traffic, web server logs. If you're logging into a website, they are also collecting your data. Traffic flow monitoring, satellite imagery is there. Like the formats I wrote down, it's nothing is compared to this. GPS tracking, web pages contact, audio downloads, banking transactions, audio content, government documentation like your ID proof, telemetry from the consumers, commercial operated vehicles, financial market data. There is a lot, like so much data that is being captured these days. So for that, we have these four V's that represents this big data. Velocity. Velocity is the speed of data. At high speed, the data is being changed. Now, what the problem is happening, just as you collect the data and start, evaluating it, analyzing it, but the speed is so high that at the time you analyze it, the data would have been already changed. The trend would have been changed, right? So this is why it is very important to analyze it in real time. Volume is the same, like the huge quantities of data that we are collecting now, which a manual person cannot be able to analyze it now. Variety is the types of formats that you can collect at, like your text, audio, GPS data, and many more. Then you have veracity tells you about the truthfulness of the data. Is what we collecting is actually truthful? Is it correct? Is it accurate or not? Because even if we are when entering into website, we won't easily write down our real name, isn't that so? We use different names so that our data is not stolen. So that is the same. If that company is collecting data, that company is going to get inaccurate data. So similarly, if what we are collecting as a company, is that data also accurate or not? That is the main question there. So for data have to be any value when being used for the decision making, it's in business, it needs to be truthful. Otherwise, it may not present a bias or contain inconsistency. The use of poor quality of data may have been expensive to collect, to analyze, and far reaching consequences for the organization which rely on it for making strategically important decisions. Okay. Then we have big data management, how we are going to manage this data. So the storing of this data, administration and control of this vast quantity of data is important, because now that we have collected and analyzed, but now you need to manage it proper manner. So there are data warehouse now. Data warehouse where we have cloud applications also, where we can upload and organize and sort our data in a better way. Big data analytics is scrutinizing of the all that data to identify the patterns, correlation, relationship, and other insights to establish a trend, to establish information, useful information for a company to further make decision. Maybe we can find out that this particular segment of customer is liking our product. So what we do, we make an advertisement which is particularly targeting that segment of customers. That is how big data analytics helps. Okay. Big data sources may not fit into currently available data warehouse, like the data warehouse I told you, like your cloud ones. Big data analytics may require more advanced software now. And those commonly use your data mining. Data mining is the your mining of the big data. Open source technology such as Hadoop has come, which will manage your constantly evolving data processing requirements of the big data. Hadoop is, you just need to remember, like, that, yeah, this software exists, which, data scientists use it for analyzing of your data. Then we have benefits and risk behind this. So big benefits are there, like we can drive innovations by reducing the time taken to answer the key business questions and make decisions, gain competitive advantage, because if we know we have a lot of data, we can make we can predict so many things out of that. Improve productivity, we can analyze our own operations and understand where the non value adding activities are, where inefficiencies are, and finally improve the productivity. Then we have risk, like the major risk is availability of skill, as it is a data that requires big softwares, and understanding that softwares is important, right? So there is an increasing need to combine the data analysis risk skills with deep understanding of industry being analyzed, and this is not always recognized. Security of data, security of data is a major concern, because the data is like a new fuel now. Everyone wants to collect this data, right? So there is a greater chance of leaks and losses. Similarly, data protection is involved. Data protection is important, because everyone want to hack into your software and take all that data for their own benefit, which is why we need to have major firewalls involved. We have good software which will protect our data, and no one can stall these confidential data. Okay, any doubt till now? I hope I'm
No,
not going too fast.
it's fine.
Okay, then let's see questions. They are so pretty simple questions. Why not a complicated one? Mm-mm-mm.
We also didn't do the decision tree, yeah, yesterday.
Yeah, we will do that. Okay. Amil is setting up a business importing French cheese. She could open up a small shop, a large outlet, or no shop at all. Okay, so there is also a option of no shop at all. If she decides to sell online only, she won't be able to do for another few years at least. There will be 5 years lease for a on a new shop currently available in the center of town, and Amil wants to make the correct decision. Amil is also thinking about hiring a consultant to conduct a market research study. If the study conducted, the results indicate the cheese market is favorable. Okay, so if she conducts some strategy, so let's say that if this is a meal, she could either go for no shop, she could go for a lease, and then she could either go for the study, for the market research, or she could not go for the market research. This is market research, and this is no market research. And if she does the market research and the results indicate that the cheese market is either favorable or unfavorable. So there is again two options, either favorable or unfavorable. So Amil believes that there is a 50-50 chance that the market will be favorable. So the both is 50-50% chance, and expect the profits to be as follows. So if there is a favorable market, she could again either go for a large shop or a small shop. If she goes for a large shop, it is a $60,000 of profit, and small shop will get the $30,000 of profit. If the market is unfavorable, remember, here unfavorable, right? No, here unfavorable. So she could again go for either large shop or a small shop. Similarly, she will incur the loss with that. The consultant has quoted of $5,000 for his market research, and he also hinted that there will be 0% possibility that the survey will indicate the cheese market would be favorable. That means market will give us the market research could give that it is favorable, that is your 0.6 or 60%, and unfavorability is your 0.4. Then there is a 0.9% that the cheese market will be favorable when given favorable outcome from the study, and the consultant warned that a meal that there is only probability of 12% of favorable market if the market research does not found it unfavorable, not favorable. So if it is not favorable, then again it will be 0.12, sorry, 12%. So let's see the table. 1 second. Right, can you see the screen?
Yeah.
So here you understand that what is a square represents and what a circle represents.
Mm-hmm.
So square is your decision and
Yeah.
circle is your expected value that is going to come. So she has two options. First of all, going for a market research and going for no market research. So if she does go for a market research, she will have to pay for $5,000 for the consultant fee. And if she does the market research, there is a two possibilities, either favorable market or unfavorable market. Okay, then again, if it is a favorable market, she has to make a decision. Remember, scare is your decision where you have to make based upon your expected values. So she can either get a small shop, large shop, or a no shop. So if she does make a small shop, there is again a possibilities of favorable market and an unfavorable market. That is your 90% and 10%. If she goes with the 90%, she will get with the small shop 30,000, and with unfavorability there is a possibility of loss of 10,000. Confused?
No, yeah, it's fine.
It's fine. Okay, with the
Yeah.
large shop there is a possibility of again 90% and 10% of unfavorability, that is your the given figures. Now with this help of given figures you will have to calculate your expected value. So 90% into 60,000 and 10% into 40,000.
I should do that.
Yeah,
What was it? No market
90,
research.
yeah, for both of them. For market research, small and large shop.
The figures are not very clear actually.
Yeah, so 0.9 into 30,000 and 0.1 into minus 10,000 or loss of 10,000.
26,000.
26,000. And for large shop, 90% into 60,000 and 1%, 10% into minus 40,000.
And 10% into
Minus
minus
40,000.
minus 40,000. Okay.
This will be zero with no shop.
Thousand, thousand, 1,400.
Are you sure?
Oh, wait. 60,000 into 0.9 minus 0.1 into 5,000.
5,000?
The
Is it
first,
5,000?
wait, 40,000. Okay, sorry.
I think it's 50,000. So 0.9 into 60,000 and 0.1 into 40, minus 40,000. That's your 50,000.
Okay.
Should I do with the calculator here?
Yeah, because for me the figures are very confusing. I mean, like the screen.
Okay, one second. So for, let me do this here. Small shop, okay, 0.9 is
Mm-hmm.
your favorable market multiplied by the profit that you're getting is 30K. Even if you see in the question, right? 0.1% of probability of with your minus 10,000 of your loss. And for a
You
large shop,
are you doing any calculations over here on the
I'm
screen?
writing on the screen. Oh, you can't see on the screen.
Oh,
Okay, one second. Okay. Can you see the screen now? Now?
yeah, yeah.
Okay. So basically, I'll show you one thing before going ahead with this. Right. Okay. As per this question, you know, there is two things. Either she could do the market research or she could not do the market research. So if she does not do the market research, Amil believes that there is a 50-50% chance of the favorability of the market. And this is the profits that she think is going to come. Okay, and she believes that there is a 0.9% of probability that there is a favorable this is as per your market research, sorry, as per market research there is a probability of 0.9% of favorable and unfavorable is your zero point 0.1 automatically,
Mm,
right?
yeah.
And consultant want a meal that there is only 0.12% of favorable market if the research, so research could also show favorable and unfavorable, so market research could also show not favorable, that there's a chance of 0.10. Okay, now I'll go back and show you that she could do market research or she could not do the market research. If she does do the market research, there is again favorable market coming and unfavorable market coming as per the market research. Now if there is a favorable market and she goes for a shop, again there is a possibility that actually it is going to come favorable or unfavorable. This was a prediction, okay, made by the market researcher, and this is what is actually happening.
Mm-mm.
Okay, so after getting a prediction of favorable market, she goes for a small shop, and small shop can give her 0.9% probability with the 30,000 of profit, or zero point 0.1 into your loss of 10,000. That is your 26K of expected value. With a large shop, there is a zero point 0.9 into 60,000 of profit and zero point 0.1 into loss of 40,000. Okay, this is your
Okay.
expected value of 50.
Okay.
So, what do you think here making a decision if the small shop is giving the expected value of 26K, large shop is giving you 50,000, and no shop is giving you zero?
Mm-hmm.
What decision should she make after the prediction is favorable?
Take the large shop.
Yes, take the large shop. So you will, what you will do making a decision, you will cut it like with the two hyphens. That indicates that this is the route that you want to go ahead with. Okay?
Okay.
Any doubt? So basically, we move backwards in a decision tree. We will first calculate all the expected values, then make a decision, and then go back here. So if I go, if market research says unfavorable, again there is three choices from in front of me, whether to do a small shop, large shop, and a no shop. No shop is you're going to be zero. Now calculate this. If the small shop, what is this probabilities? 0.12 into 30K and 0.88 into minus 10. Calculate this.
5,200.
And if for large shop it is 0.12 into 60 and 0.88 into minus 40.
28. Oh, wait.
Yeah, 28.
28? Yeah, okay.
Yes. So you should wait, minus 40. It is negative 28.
Yeah, negative, negative. Sorry.
So now which decision should she make?
Go for the small shop.
Hmm. This is also negative.
Um, okay.
Yeah.
Um,
So she should go for no shop
okay, yes.
because this is zero. Better than a loss of 5.2 or 28. All
Is
right.
that option like there in the question, like
Yeah, yeah, of course.
no
She
shop
have
that's
mentioned.
mentioned?
Yes, she has mentioned. Yeah. Here you can see that no shop at all if she decides to sell online only.
Okay, okay,
Okay.
okay.
So, where were we? Yeah. So, here you will have to write down on this decision scare, basically, the expected value that is coming out. So, here it is 50 in this decision, and in this decision, it is 0.
Zero.
Correct? Now, which
Yeah,
one is more higher? 50?
it's 50. Yeah.
So, sorry, you will again have to, this is not a decision box, right? You will just have to write down the expected value in this circle. So, 60, 0.6 into 50, and 0.4 into 0. What is the expected value of that?
30.
30. Here you will have to make a decision on
Mm.
getting a market research or no market research.
Mm-hmm.
Okay, so let me erase this all. Just write down this 50, 0, and what was there? 30.
30, yeah.
Okay. Now here in no market research, again, we have three options, small, large, and no shop. So
Mm-hmm.
calculate this possibility, 50 into 30 and 50 into minus 10.
10?
Negative 10.
Negative 10, sorry.
Yeah. No, this is 10 positive. I'm saying this is negative 10.
Okay,
Okay.
yeah. Okay.
For next, it is 50% into 60 and minus 50% into negative 40. This is also 10.
Yeah.
So we can go either way, either this or either this. So this is going to be the same 10. Now, again, here we have to make a decision either for a market research or no market research. What do you think should be the answer?
There is another expense also, yeah, for
Yes, right.
30 minus 5, 5 or
Hmm.
50.
Still, which
And
decision we will be making?
still the market research.
Yes, so the answer is going to be your expected value of 25,000.
Okay.
Okay. I know this is a lengthy question, but remember, even in the exam, what they will give you, tell us only about this scare. So we'll have to calculate these calculations rather than doing the whole. Or they will write down this 50 for you and here 0 for you. They will ask you to calculate this circle value.
Okay.
Okay, it will come like that, but for understanding of how we are supposed to calculate a decision tree, for that we have this type of questions here.
Okay.
Okay, I hope decision tree calculate.
Hello? Your voice is breaking actually. Hello?
Can you hear me now?
Yeah.
Oh, better. Okay. So I was saying that I hope you got an understanding about how to calculate decision trees
Yeah. Um,
better.
yeah.
Otherwise,
I,
we will do
uh,
questions next weekend more on your risk. So we have more. We will do more question. I'll try to make new questions on this risk chapters for you. Let's see. Then we can take more decision tree if you have still trouble with this. Okay.
okay.
Okay, last this is make versus buy. So in make versus buy, we have two options either to make it in-house and buy from the outside or outsource it. So here again, you will have to make a decision based upon the contribution where we are getting better. If we are outsourcing from outside, there is a cost involved of purchasing it outside. So selling price we might could get higher from the outside, but again in making it in-house there are costs relating to your like a variable cost, fixed cost, so that we have to take consideration here. So similarly you just have to make the decision based upon your contribution, whichever is wherever you are getting higher. So if there is a 6 contribution of buying from the outsource, we should outsource it. Okay, and this is nothing but your sensitivity analysis. But if the external price changes and falls to the outsource needs fall to the $5 per unit, so what we are doing here, the change is 1 per unit, so 1 divided by the previous your this is your flow of consideration, so 6, 1 divided by 6 is your 17%. Okay.
Okay.
So one is basically your NPV. NPV is what the benefit you are getting. That is your 5 minus 6. That is your 1. NPV
Okay.
divided by present value of flow we take, right? So NPV is here 1. And consideration what we are taking is here the outsourcing price. That is your 6. So it's 1 divided by 6 that it is. So if our price changes by 17%, our NPV is going to be 0. Okay.
Yeah.
Any doubt?
No.
No. So for now we have completed